I am delighted for this episode to be joined by Dinesh Kanabar, who is the CEO of Dhruva Advisors. Dhruva Advisors, of course, is the largest tax boutique consultancy in India and the UAE outside of the Big Four. Dinesh is an international tax expert. He is a guy I go to on insights. And given we've had some very interesting news from the UAE, I thought it would be an interesting time to sit down with Dinesh for a little while and get his take. So we have the introduction of corporate tax in the UAE. Dinesh, you're very welcome to Successful Perspectives. Maybe you could start off by breaking down this introduction of corporate tax, the background, what are some of the key issues as you see it? What exactly is happening, first of all?
Thank you, Trevor, for having me on this Successful Perspectives. Delighted to be here, and thank you for a very, very generous introduction. When UAE announced just about 3 months ago, in January for that matter, to go back and say that we are going to introduce corporate tax with effect from accounting years, which commence after 1st June 23, it was really a seismic change, if I may call so. This region has prided itself as being virtually a tax-free zone. About 3 years ago, we introduced VAT, and now we have corporate tax. And therefore, what was really a laissez-faire is now getting into a regulated framework. And it couldn't have happened at a better time. And I'll tell you why I made this comment. Two things. UAE has grown and grown and grown. And today, people come to UAE for ease of doing business, for what it is able to successfully provide as a platform to entrepreneurs, rather than merely the tax advantage. Gone are those days when merely because you had a tax advantage, you came to UAE. Therefore, the economy has a resilience where tax really does not matter because it is self-sustaining. Number two, the world has converged on taxes. And OECD came up with what we call technically as a two-pillar solution. The second pillar being that globally countries must not compete on the basis of taxation, but on the basis of their inherent strength. And they provided that every country should have at least a 15% tax. Now, UAE came back. You had a choice of being outside this whole thing. Instead, it did a very, very sensible thing. It became part of what we call as an inclusive framework comprising of 123 top countries in the world. It signed that inclusive framework, which contained this pillar 1 and pillar 2. And lo and behold, it has now rolled out this tax, which is forward looking. The inclusive framework comes with effect from 1st January 23. UAE sort of stepped back a little bit and is introducing taxes for accounting years commencing from 1st June 23. The rate of tax is a very lucrative rate. It is 9% for general companies. And for those companies which have a turnover of more than 750 million euro and which are multinational, the rate is to be prescribed. Most likely that will be 15%. So here is UAE telling the world that we want to be consistent with the global framework. We are not an outlier. Don't view us as a tax haven. We are a country which understands business, which provides you a platform to grow, not merely on the basis of tax holidays.
Wonderful, Dinesh. Let's imagine this scenario. I'm the regional CEO of a big multinational company based here in Dubai or Abu Dhabi, and I'm overseeing Middle East and Africa, or maybe even India, Middle East and Africa. What does this mean for them as a regional CEO?
That's a very good question, Trevor. The tax is still a couple of years away. So depending, let's assume that most organizations there have calendar year as an accounting year. So let's assume your year ends on 31st December 23, which means that the income you earn from Jan 24 is liable to tax. Now remember, Trevor, that the law has not yet been announced. What the government has done is to give a framework in the form of FAQs, which was given out in January 22. And then in May or June this year, we are going to see the law itself. So to some extent, what I'm telling you is a bit forward looking because I don't have the law, but the framework is robust enough to understand what the law is likely to be. So if I am a regional CEO and I'm looking at this whole region, I need to start thinking that till now, I wanted all my profits to be sort of accruing or parked in the UAE on the basis that there were no taxes at all. No longer so. For example, today, local businesses in UAE, the owners never really charge compensation. Remember that this tax is only on businesses, not on individuals. It's called as corporate tax, but it's actually a tax on all businesses which are corporate or otherwise. Now, let's go back to something like EMIR. Today, if you are the owner, you are not going to charge remuneration for your time because you're going to get profits at the end of it. Now, if you were to charge remuneration, that remuneration is tax-free in your hands, whereas it's deductible for the company. So am I charging an appropriate remuneration? Go a little bit more. If you are funding your business, you are not going to charge interest to your own business because it doesn't really matter. Now, within the norms of Sharia law, you would be well advised to charge interest because that interest is tax deductible for the business, but no tax is payable by the recipient of the interest, which is an individual. There will, of course, be thin pricing regulations and things like that, but you need to start focusing on that. How will you own assets? Will you own assets in the business or individually? And could you really own the assets individually and charge rent to your businesses? That rent will become tax deductible, whereas the rent which you get, you don't have to pay taxes. How do you work around this? How do you relocate your IPs? There's again a very interesting thing which UAE has done. They have gone back and said that if you are operating from out of free zones and we have given you a tax holiday, which is a 50-year tax holiday, you're going to honor all our commitments. And that's a mark of a robust tax framework. You don't go back on your commitments. Now, do you have a business both in the free zone and onshore? How do you structure relationships between them? We have to look at the law as to how those transactions can or cannot be done, but how do you really work on it? So a number of things which need to happen. And then we will go back and say, if I am operating globally, there are entities overseas where I'm either paying a higher rate of tax or a much lower rate of tax. How will I deal with this? So a number of those issues I need to factor, and each one of those issues is going to determine what we call as the effective tax rate of my company. And I need to start thinking about it, Trevor, here and now. I don't have the luxury of waiting till 23 for two reasons. 23 is round the corner, and people did wait until the last moment for VAT, and the government actually implemented the way they said, and they were not prepared. So here you need to be prepared. But more important, Trevor, if you restructure yourself for tax effectiveness just before the law comes, there is a concept known as general anti-avoidance rule, which essentially says that if you restructure only to avoid taxes, that restructuring can be disregarded by the government. You don't want that to happen. You want a couple of years to go by before the law kicks in so that you are well prepared. You can say this was your consistent accounting practice. Here are a couple of years of accounts which demonstrate that. So when the law kicks in, it's something which is a part of your framework. Final comment. You could always be seeding new businesses. And when businesses are seeded, there are losses initially. And then you start paying profits. What the framework of the law in UAE says is that if you have losses and the losses occur after the law is effective, you get a set off against future profits. But what happens to the losses which are occurring currently? How do you structure them in a manner that they really are made available to you when you start making profits? Because the last thing you want is losses to go aside, and when profits kick in, you start paying taxes. So number of things to be done out.
Really, really great advice. And you can see the devil is in the detail here. It's a lot more detail. There's a lot more implications than you think of when you just look at it at first glance. What do you feel are some of the most common pitfalls that companies, organizations, or CEOs tend to fall into, whether it be a mindset when there's an introduction of a new tax? What usually how do they usually make mistakes?
Trevor, it's actually a very interesting question. Most professionals see maybe once or twice in a lifetime the introduction of a tax. UAE is a rare example where taxes are being introduced today. In most parts of the developed world, taxes have been around for a century or more. So to answer your question would mean to say, oh, where all were taxes introduced very, very recently, and those are very, very few handful countries. But I think the biggest thing is not to recognize in advance that what worked. So let me put an example. In UAE today, while auditing is mandatory, there is no oversight on audit. There is really no requirement where somebody external is going to look at your accounts. You give your accounts to a bank and the bank is going to evaluate whether you are credit worthy or not. Now you have a tax guy who's going to look at your accounts for the first time. You are making a disclosure of what you are. And you got to be very careful about what you're doing out there. And when I say careful, I'm not saying that until now what you did was incorrect, but till now it didn't matter. Now somebody's going to look at and say, those expenditure which you are claiming as tax deductible don't relate to your business, because only those can be sort of debited to profit and loss account. So today, it didn't matter as to whether there was a personal expenditure in the profit and loss account because nobody cared about it. Now you suddenly need to care between what is personal, what is business. So the whole mindset has to undergo a change where you will go back and say that somebody external is going to look at my accounts, every entry in the accounts, ask me a question which never happened thus far. That is the fundamental change, Trevor.
What about from the government, the UAE government's perspective? This is quite a big operation. You know, the introduction of a new tax, as you say, it's rare that a new tax is introduced. Managing that project itself is quite a big undertaking. What advice would you give there, or what's your take on how the UAE government should approach this?
In fact, the advice which I would want to give is probably the advice they already are following in a sense, because if you look at the FAQs, what they've gone about is to really give a framework. First thing they said is, we are going to honor all our past commitments. The rate of tax is modest. What happens in most tax jurisdictions, whether you look at the IRS in the USA, the Revenue Department, Her Majesty's Revenue in UK, or the Indian taxes, people view tax administration as being very, very aggressive, as being somebody who's going to come after your blood. And that it ought not to create that friction between the taxpayers and the revenue. That's the fundamental piece of advice that I would give to the UAE authorities. The fact of the matter is, here is a region which is not used to taxes. You have to give people a little bit of time, a little bit of elbow room to settle down. So for example, as I mentioned to you, that people have not been used to preparing accounts which are capable of a review by a regulator. Now they will start preparing. And there may not be perfection in year one. Perfection will come in year two, year three. There'll be issues, for example, like ceiling on managerial remuneration, how much debt you can take, thin capitalization, transfer pricing. These are inevitable adjuncts, Trevor, to taxes. Tax doesn't come on its own. We're going to say you can't take away all your profits as compensation. You can't pay usurious interest to yourself and reduce your profits. The relationship between you, the owner, and the related parties has to be at an arm's length. Now, when you start putting all of those, you are really encircling the business into a framework. If it is too tight a straight jacket, the businesses feel suffocated. If it is too wide, then businesses will take advantage. So drawing that thin line in the sand of allowing people to do their own things, giving them that latitude, yet at the same time correcting the right takes. That's what it takes for a revenue. And I can quite see that UAE is actually geared towards that.
Dinesh, one last question. You've been very kind with your expert advice. One last question is, over the longer term into the future, how do you see the UAE in terms of its tax environment? You mentioned in the introduction to this conversation that there's a desire of some kind of alignment with OECD statements in terms of different governments around the world having a system that makes the system better. Let's keep it simple. So where do you see the UAE and its tax environment, over the next 10, 15 years or so? What's the direction of travel as you see it?
Trevor, in fact, that's a really great question. I'll tell you why. The world of tax globally is very nebulous today. We have got this pillar one and pillar two. Pillar two is what we are talking about today, a minimum rate of tax. But pillar one, which is where the world is going to today, is taxation of digital economy. The whole economy is getting digitized. Not merely e-commerce, but in more ways than one. Today, business is conducted digitally. And in a digital world, physical presence is irrelevant, Trevor. So until now, the global framework of taxes was you paid taxes in a country where you were incorporated, residing, managed, etc. You were taxed in the other country as an MNC only and only if you had a physical presence, what we call as a permanent establishment. That concept is being given a burial. Now, there is a proposition that if you are a global multinational, you can be taxed on the basis of markets. And there is no bigger market than UAE because there are global companies which come and trade in the UAE, and UAE is not collecting taxes from them. Now, that will mean introduction of pillar one, which is a far more complex. In fact, if I start explaining to you how pillar one is structured, you will say, wow, Dinesh, this is like almost nuclear physics. So the way I see is that globally tax regimes will converge. There will be issues where MNCs will come back and say, I don't want to get into fight. Here is my accounts. These are visible globally. I am transparent. You countries decide what I should pay wherever because I am indifferent to it. Somewhere I can see tax rates converge. I can see social approach converge. So it's a long-term direction, and UAE will be part of that global evolution and not a standalone.
Dinesh, this conversation has been educational, insightful, and very interesting. Really appreciate your time. Nice to see you, and thank you very much for being on Successful Perspectives.
Thank you, Trevor. Thank you once again for this opportunity.